Hello, everybody. Welcome to and Ask Me Anything on asymmetric investing. This is something I'm going to try to do more of here on the channel. We'll see if memberships are something that makes sense to do this on a more regular basis, like once a week or something like that. But the idea here, especially for people who are subscribed to the newsletter, is to give a little bit more feedback, have a little bit more in-depth discussion, and then just answer your questions. So I actually have 15 questions in the queue that have come from the newsletter. That's where I'm going to be starting today. But if you have comments or questions, put those in the chat, whether you're listening on YouTube or it should be available on Twitter as well. I should see those. Also, let me know if there's any sort of technical difficulties, like you can't hear me or anything like that. But I do want to start by just explaining for those of you who might be new here exactly what we're doing, what I'm doing with asymmetric investing. This is basically what it's all about, is beating the market long term. So this is called the asymmetric portfolio that I have built to beat the market, use all the principles that I'm using on asymmetric investing, buy stocks with 10x potential, hold them long term, think a little bit differently than the market. I'm focused on what is a company going to be 10 years? What's the strategy that's going to drive that? Are you paying a good valuation? I'm not necessarily concerned about what's going to happen over the next quarter or the next month with a given stock. And the results kind of speak for themselves. So this is the portfolio. I buy stocks once a month. Those buys went out yesterday, which is the reason that I'm doing this AMA today. If you have any questions about what those buys were, or the spotlight that I put out on Sunday, the way that I do the asymmetric portfolio is I do a spotlight article to kind of initiate coverage. It would be kind of the way to think about it. Once I've done a spotlight on a stock, then that stock goes into what I call the asymmetric universe of stocks. And then each month I'm buying stocks from that universe. So right now, I think there's 24 stocks in the asymmetric universe. So as I buy stocks every month, it's going to be one of those 24 stocks, or multiple of those 24 stocks, more likely, that I'm going to buy each month. And I'm doing that. I started that from scratch, doing this with $500 a month. So not a huge amount of money, but the idea here is I want to make this identifiable for everybody. If you're investing $5,000 a month, great. Then, adjust accordingly. But this should be sort of research and me showing my work to people who are subscribed. So that's the idea behind asymmetric investing, if you're new to the channel or the newsletter. So sign up there if you want more from me. And I'm going to jump right in with questions. These are, like I said, questions that came in from the newsletter. I've been asking for those questions for a couple of weeks, and I'm going to also I've got Fiscal AI here pulled up to just help out looking at valuations and things like that. But a lot of these are kind of more philosophical questions. So let's start with this one. First one is from Jack. Asymmetric equity value makes a lot of sense to me, but what do you think about leveraging the asymmetric tools of options? Options is something that I've used in what I call my special situations portfolio. That portfolio, and it sort of came organically as the market got a little bit overvalued earlier this year. I was thinking, I want to be able to, the principles of the portfolio is I'm going to say fully invested. So there's never going to be cash sitting in the asymmetric portfolio, and I'm going to buy stocks once a month and deploy all that cash that I put in. That's something that I want to stick to because I don't want to time the market, and I want to just demonstrate that over time. But there are periods of time where I see opportunities to basically bet against a stock. Maybe that's because of valuation. Maybe it's because I think the market has just gone crazy with something like memes or something like that. So I started that earlier this year. One short position did extremely well. I sold it for 260% profit. And then I have a couple of positions. And what I'm doing is I'm buying long dated puts. So these are leaps that right now they expire in 2028, I believe it is. So I've got a long time before these expire. And what you do is you put an amount of money on, I'm buying out of the money options. So when you buy a put, you say, let's say a stock trades for $100. You say, I want to buy an option to sell it for $50. So the stock has to fall quite a ways The advantage of doing that is when you have this long dated option, if volatility increases in the market, so I'm typically doing this when volatility is relatively low. When volatility increases, the value of those options increase. It gets a lot into options pricing and Black-Scholes and stuff like that. But basically, when the arbitrage for options, think of it like a pendulum going back and forth. So if you are arbitraging the options value, you're basically taking out that volatility or trading that volatility, and the volatility is really low, you're going to say, you know what, I'm not going to pay a lot for that option. But then when volatility gets really high, that pendulum swings a lot more violently. So then the value of that option goes up. So I make money in two ways from those options, at least over the next, let's say 6 months to a year, is if volatility goes up, like it has over the past couple of months, those options will go up in value. And if I'm right and the stock goes down, then the option will go up in value. The reason that I use those with short positions is because I know exactly what I could possibly lose. If I buy an option for $100, I can never lose more than $100. The problem with shorting a stock is you can short $100 worth of stock. The stock may 10x in value. Now you've lost $900. So that's why I use them in short positions. I don't use them typically in long positions. At least I haven't on the asymmetric portfolio, because you have to be right about two things. You have to be right about the timing and the direction. And I've just found that the opportunity cost is not really there for me right now. If we get to a point where the market crashes and we go through something like a 2008 to 2009 scenario, I may decide that, you know what, it makes sense for me to use options on the upside as well. So I've done that. SunPower is a big position. You can go back in my disclosures in the Motley Fool that I had $5, $7 options in, I think it was 2012, 2013. So that did really well, but that was, the market was kind of pricing them going out of business, which they eventually did go bankrupt, but that was many years later. So something that I've considered, not something that I am currently using. So that's the way to think about that one. All right, let's go to the next question. Make sure I have this right. And this comes from Chris. What are your thoughts on interest rates and where they're headed over the next year? He has a lot more context in here, but he says, basically, given the long duration of the risk assets that you're holding, if interest rates go down, it should increase that value. If you're using something like a DCF model, a discounted cash flow model, it depends significantly on the assumptions, but most don't spend a lot of time on that. Really detailed question, and this gets into something that's called the capital asset pricing model, something you learn in business school. Basically, the idea here is you build a model that predicts the cash flows of a company over a long period of time. So you may say, okay, I'm going to predict out the next 5 years of a certain company. I'm going to predict their growth rate. I'm going to predict their margins. And then you eventually get to cash flow, and then you discount those cash flows back to present value. The reason the discount rate, the interest rate, is important is if the interest rate goes down, the value of those further out cash flows goes up. So what Chris is asking is, look, if interest rates are going to go lower, then I should be more excited about long duration assets. So stocks that have maybe higher upside in the future. Whereas if interest rates go up, interest rates actually have gone up, or at least the interest rates that matter, which is like the 10-year or the 30-year, those have gone up, or the recently, even though the Fed funds rate has come down. So that's kind of the push and pull there. Chris, to be honest, I don't think a lot about interest rates. And the reason is it's not something that I can control. And it also doesn't typically have the predictive effect on stock valuations that a lot of people think it does. So the short-term reaction in the market is typically that if interest rates are coming down or the Fed is reducing interest rates, then the value of stocks will go up because of that capital asset pricing model context that I talked about. The reality is, if the Fed is cutting interest rates, it's probably because the economy is not doing well. And if the economy is not doing well, that is going to overwhelm the higher valuation in your DCF model. So if you look at something like 2007 through 2009, short-term interest rates were coming down, even long-term interest rates were coming down, and stocks cratered. So this is one of the things that I always you have to think a little bit contrarian or a little bit like what's the second or third order effect. And when I hear especially banking CEOs talk about, you know what, if interest rates come down, that's going to be great for us. Maybe not, because if people stop paying their bills because the economy stinks, that's not going to be good. So that's really the reason that I don't spend a lot of time thinking about interest rates, because it's not something I can control, and oftentimes the impacts are sort of the opposite of what you would think. Let me clear out some of these questions here. Next one, and there was a couple of questions about REITs, so I'll just answer this one here. But David asks, are high yielding REITs on your radar, and do they belong in most portfolios? Are they priced fairly, or are they a bargain? So if you're not familiar with REITs, basically, real estate investment trust owns an asset. So if you go to like an Applebee's doesn't actually own, I don't know why Applebee's is my example, but they don't actually own the building. There's a REIT that owns that building typically. I think Applebee's is one of the examples. Hotels is another example. Hilton doesn't own a lot of its own hotels. There's a REIT that owns the hotel, and then there's an operator who actually operates it. So it gets to, you're trying to split the business into multiple pieces to try to get the best financing structure. Even casinos have moved this way. So I've been following the casino industry for a long time. When I first started covering the industry in the mid 2000s, all of the casinos owned all their own real estate. They don't own much of that real estate anymore. That's owned by REITs like Vici. So the question is, are high yielding REITs on my radar? Not really for the asymmetric portfolio. It's something, these are things that I have bought in the past to just look for yield. I help manage like my parents' portfolio. That's a place that I would consider them, but it's not really something that I see the kind of asymmetric upside potential for my own portfolio or for the asymmetric portfolio. So that's the reason it hasn't really been something that I've focused a lot on. Does it belong in in most portfolios? I can't answer that, and this is going to be the theme here. Is I'm not able to answer specific personalized questions, so I'm going to answer all of these based on here's what I'm doing. Um, it's definitely something I think that investors should consider. Maybe it's something that makes sense if you're looking for yield. If you find an asset that you think can pay out that dividend for a very long period of time. The thing that I would caution with REITs in general is don't just look at the yield. That yield number is an outcome of the cash flows that are coming into the business. What you have to look at is what's underneath that yield. Who is paying that bill? So, for example, if you own a mall REIT that pays a 10% dividend yield, and then malls go out of style, nobody's going to malls anymore. Guess what? Nobody's paying that bill. So that yield that you think is safe because it's a REIT isn't actually safe. So I will look at what's the underlying business, and then what's the future of that business, and then what's the coverage ratio or the cash flows that are coming for the business. So like take casinos as an example, because they have gone through this transition recently. The upside with REITs is actually really small because there are caps on the amount of rent increase that they can have. So it is tied to kind of the operations of the business. But those rent increases will only be 2 to 3% depending on the contract. The so the REIT is basically just going to pay out what you see as the yield and maybe a slight increase in the future. But then when you look at casino companies, look at what were their operations, what did they look like when they signed that deal, and maybe let's say 2018, 2019, and what are they today? Likely that cash flow has jumped because Las Vegas is actually generating a lot more gaming revenue and revenue overall than it was before the pandemic. So actually, those REITs are sitting pretty good from a risk reward standpoint, but you're not going to have a lot of increase in the yield of that cash flow asset. So just understanding the entire ecosystem, I think, is really important, not just looking at that yield. So hopefully that's helpful. It's on my radar. Probably not something that's gonna end up in the asymmetric portfolio. Next question is about how do you hold positions when they're up so much year to date? When are you sitting on cash, and when is it time to return to the market? So this is really kind of about market timing, and this is one of the things I try to take out with the asymmetric portfolio. Is I say that I'm investing a certain amount every single month, and the reason that I do that is because That's the way that most people invest, right? You're building a portfolio. You're probably not gifted $1 million, and then your job is to just grow that over time. You're probably investing $100 a month, $500 a month, $1,000 a month, wherever, whether it's in your 401k, whether it's an individual brokerage account. So I'm staying fully invested in that account. How do I hold positions when they're up year to date so much? Again, my default is to not sell. I actually sold a couple of stocks yesterday. So that was all sent out to subscribers before the market opened. But that's kind of the hardest thing for me as an investor. And the thing that I have learned is that we should default to not sell, because if you own great companies, the biggest mistake that you can make is sell them to think that the price will get better in the future. You can look at Netflix, Nvidia, Amazon, Apple. I mean, ask any investor what their horror stories are, and it's probably selling stocks, selling some great company that you owned that 10x, 100x in value, and you would have had $1 million, $5 million. I mean, anybody that's doing this for a long period of time has those kind of stories. I sold Chipotle. I owned Chipotle back in 2007, I think it was, back when they had A shares and B shares. And actually, the B shares had 10 times the voting value, but they traded for like a 10% discount to the A shares. It didn't make any sense. And that was when there was David Einhorn, I think, was actually short the stock because he just didn't understand Chipotle. Well, guess what? People love going to Chipotle. So that stock has done extremely well. It wasn't all that expensive then. The fact that meat prices were going up, again, those short-term things just didn't matter to the long-term story of the stock. So that's why I default to not selling. Couple of, I put out an email on Sunday that explained kind of the things about, here's when I do sell. Did the thesis change about a company? So Spotify would be a good example. I bought shares of Spotify in 2023. They were not yet profitable at that point, but they had started cutting costs. You could see in the future they were going to be increasing their prices. So things were looking better from an operational standpoint, and the valuation I thought was relatively cheap. Fast forward to today, valuation not nearly as cheap, and a lot of those tailwinds operationally have already been put into place. They've raised prices a couple of different times all around the world. How much are they going to be able to do that? Maybe that upside isn't quite what it was, and also that revenue growth has started to slow. So that's one. Stock is up, I believe, year to date, but up 500 or 600% in the asymmetric portfolio. But the thesis has changed a little bit. So if you hold stocks that are up a lot year to date, try to take a fresh look at the company, because that's really the way that you're going to look. Would you buy shares today if you didn't know anything about the past? Just try to forget that backwards looking view of the company and the fact that maybe you're up, because oftentimes the best opportunities, you already found it. You already own it. So that's why not selling is my default, unless something has changed, unless something strategically has changed. Sometimes that's the case. Sometimes it's not. Sometimes, a really, really good problem to have is this stock became 20, 30% of my portfolio because it's up so much. Should I sell? That's another really good consideration. But I don't try to time the markets at all. And the reason is we just simply don't know. I would have predicted a year ago that we would probably not have a good year this year because the market was really highly valued. Guess what? It's been a pretty good year. So I'm not able to predict those things short term. So I'm not trying to time the market in general. I am just trying to make the best decision that I can on a month in and month out basis. Over the long period of time, stocks are going to go up in value. There are so many opportunities this is from Lewis. There's so many opportunities in the market, but a new area of interest is a transition that Bitcoin miners are going through, decreasing exposure to Bitcoin and moving to artificial intelligence. So this gets to the bottleneck in AI is power. Bitcoin miners have power for a lot of their data centers. So can they make that transition to AI? There's a number of companies that have gone through this. A number of the hyperscalers have made deals with a number of these companies. I don't know how that's going to work out. So is it an opportunity? It was an opportunity, but a lot of these stocks have already gone up in value on speculation that their economics will improve pretty significantly. So it's not an area where I am focused right now, because I just don't know exactly what that upside is financially for them. or what the return on investment is going to be. One of the challenges I think with AI is we can kind of see the growth in demand that's in front of our face. So over the next 6 months, maybe 12 months, as companies invest in building better models, hyperscalers are spending hundreds of billions of dollars on building out these data centers and things like that. But what happens in 5 years? What's the business model behind AI? And ultimately, everything that I'm investing in has some sort of business model behind it. There's a strategy behind it, and I can't yet wrap my head around this is what differentiates a Bitcoin miner from another Bitcoin miner, except they have access to power. So if we get to the point in 5 years where, the chips have gotten more efficient, maybe demand moves to your phone as opposed to being on the cloud, does the economics of that business completely change? Did they take out a whole bunch of debt to build these data centers? And then eventually that becomes, something that just drags them down. That's what I worry about because I don't know strategically what's your huge advantage in the market if you're an AI company. So these are a lot of these are areas that very, very possible that they do very well in the future. It's just not an area that I'm going to focus on because I don't know where there's a point of differentiation that I can rely on long term. So, right or wrong, that's kind of my thoughts there. Very, very possible that they do fine, but try to understand those risks there when you look at some of these things. How do you determine the size of each holding in the portfolio and how many companies to own, when to purchase a new company, and when to add to existing holdings? So the way that I have built the asymmetric portfolio, like I mentioned, is just over time, I added stocks to that universe of stocks. Now that's a pretty comfortable number. Want to probably be between 20 and 30 if possible. For a while, I didn't see that many opportunities. Now I've kind of moved up a little bit. If we go to the point where the market crashes and I see a ton more opportunities, maybe that'll go up. Maybe that'll be, 35 or 40. Not quite at that point yet. So that's why there is a limit on the number of companies that you can reasonably follow and understand. Because if I own 25 companies, it means I'm probably following or understanding what's going on with at least 5 times with that, if not 10 times that, where I'm looking at press releases, looking at what their presentations are, what did earnings look like. The universe of companies that you have to follow is not 25, it's much bigger than that. And this is something that I think a lot of individual investors miss is you get really focused on one company. So like Tesla was that company over the last 10 years. And you focus on Tesla, but you don't understand you got to understand what's going on with Tesla, but then you also need to understand what's going on with GM, what's going on with Mobileye, what's going on with Waymo. So you have to follow much more than that. I only have so much time in the day. And so that's really kind of the limiting factor. And there's only certain areas of the market that really interest me because I am looking for that asymmetric potential. So utilities are not probably something I'm going to spend a lot of time looking at unless it's related to something else. So as an example, um, when do you purchase new companies versus adding to existing holdings? For me, those new companies come in when I see an opportunity. So I actually have a couple that I've started drafting spotlights. Like I said, I published one on Sunday, but there's a couple that are kind of sitting there, and I'm starting to listen to conference calls. I'm starting to go through their press releases, try to understand what's going on with the business, poke holes with that. I spend a lot of time just like walking around and thinking about companies as I listen to some of these things. That's my process. So when that stock enters that universe, then I want to think about, okay, how do I add to it? I typically want to add over time. I'm not going to just typically dump money into a single name and make it 5% in portfolio because that's partly, timing the market, but I do want to build out that position. So I've done that with a couple of stocks that I added 2 or 3 months ago, where I just brought those up to between 2 and 3% of the portfolio. That's a pretty comfortable size for a new position. Like any of these stocks, I may be right, I may be wrong, but the ones that I'm right on are going to overwhelm the losses on the ones that I'm wrong. So if there's the saying goes, if you're right, a little is enough. If you're wrong, a little is all you want. So that's the way that I think about kind of sizing those positions and sort of moving into them over time. There are times too where you might be early on a stock. So you might say, let's take one that's just keeps grinding lower. The trade desk, for example. So on my radar, stock keeps going lower. Maybe we do go through a big recovery in the trade desk, the sentiment around the company. Maybe Alphabet is a better example because that's a stock that I own. I think it's actually the biggest holding in the asymmetric portfolio today. But I was building that when the stock was trading for 15, 16, 17 times earnings. And then suddenly, and so it's like the stock is going down and you're going, am I getting this wrong? What am I thinking about wrong here? But if you're able to kind of take yourself out of that price action and look at the fundamentals and what's actually going on with the strategy, what's going on with the business and the numbers that they're reporting each quarter, eventually when that sentiment changes in the market, things can turn around really quickly and you've been slowly buying that position as it goes lower and lower and lower. You seem stupid at the time. I've done this many times because you start wondering what you get wrong, but then looking back, you go, okay, I was right. I was the rational one here. It's the market that kind of wasn't thinking about this right. So hopefully that's helpful in sort of understanding it. I think I got to all the points in the question, but um, there's no science to it. I wish there was an easy answer for a lot of these things, but there just isn't. Uh, from Brad, do you do pre-mortems on your picks, attempting to determine what's most likely to go wrong before you buy them? Absolutely. At the bottom of every single Spotlight article, there's literally a point in the post where I go, how this stock 10x is in value. My bar is 10x in value over 10 years. So I want to explain how that could happen. The next thing is how the stock 0x is in value. So how do I be completely wrong and the stock goes to zero or just completely craters in value? And if you can't make that argument, if you can't explain why you're right and explain why you might be wrong, probably not an investment you should be making. Because if you're only looking at the good, you're not able to see that bad. That also gives you a good. One of the things that's helpful in me with writing is it puts that information out there so I can go back and look at it and say, Dropbox was a stock that I had in the portfolio early on. Here's my thesis on Dropbox. Then 6 months later, is that playing out? Maybe not. So maybe I'm not buying that stock anymore. And this is kind of the history that it went through. So I'm just holding it and I'm waiting and I'm waiting. And then eventually go, you know what? Things aren't working out the way that I thought they were going to. So I'm going to get out of this position. This is not a 10x opportunity. Um, that's helpful when you write those things down ahead of time. So yeah, that's the kind of pre-mortem that I do at the bottom of every one of these spotlights. There is literally how does this stock 0x in value? Sometimes a company that has a lot of cash maybe isn't going to 0x, but it could just kind of go nowhere for a very long period of time because the growth story doesn't really materialize. Next question from Gilberto. Could you please talk a little bit about Mobileye? Would now be perhaps a good time to buy on the cheap? Are there any factual reasons that the stock is pulling back down almost 35% this year? This is one of the stocks that I own. There's a few stocks that I own related to autonomous driving. So the tailwind that I'm trying to invest in is autonomous driving and the growth that will happen there. I think the market really misunderstands. There's another question here later on about Tesla and Waymo. We can kind of dive into this a little bit more. I think the market really misunderstands how the business models are going to play out. It's really easy to see vertical integration and how a company that vertically integrates could potentially win. So the story for the last 10 years has been, you know what, Tesla is going to dominate this market because they got a million vehicles on the road. They can just, boom, make them autonomous vehicles overnight, and suddenly you have this huge fleet. That's probably not the way that things are going to play out. It's much more likely, I think, that we're going to have many suppliers of autonomous vehicles, and then one or two, maybe three sources of demand. So think about ride sharing as a good example here. This is one of the reasons I own ride sharing stocks. If you're looking for a ride, you just open up Uber or Lyft. Maybe there are other options, but the scale is in those two companies, and that is demand aggregation. What are people choosing to interact with when they're looking for a ride, when they're looking for food? This is how DoorDash has done really well recently. So those companies are trying to pull all that demand together, and then they become kind of the choke point. And then you got to think about who are the suppliers to that market. Well, if there's only one company that figures out autonomous driving, they don't need Uber and Lyft. But guess what? There's fully autonomous today. We have WeRide actually is operating fully autonomous in the UAE right now. You have Waymo, May Mobility, and Mobileye are both operating with a safety driver in the vehicle. Tesla has safety drivers in the vehicle. There's a half dozen at least other companies, if not more. So you look at there's probably there's probably 10 to 15 companies globally that are sort of in this phase of we see how we're going to get to fully autonomous vehicles. Maybe it's level 4, maybe it's level 5. The details of that doesn't really matter because I think mapping is not going to be the huge problem that people thought it was. A few years ago, even Tesla's mapping their areas, but there's going to be many more suppliers than one. And if that's the case, then you have to think about the business being much more modular. So maybe Uber and Lyft win that demand side, but then what does the supply side look like? Well, maybe a technology company is providing technology to a whole bunch of different automakers. That's Mobileye's business model. So Mobileye is going to go in and say, okay, Volkswagen, you want to have a fully autonomous vehicle. Guess what? You're not doing this research yourself. You're not doing all the work that Tesla has done, that Waymo has done. You want to catch up. We'll sell you the software and some of the hardware to just catch up, and you can be fully autonomous right away. That's the business model for Mobileye. The challenge for them right now is they're still in that testing phase, and we haven't gotten to the point where they're rolling out big programs with big signings. So it's very possible that I'm wrong about that. This is one of the reasons that I haven't quite invested in some of the other tech companies that would play a similar modular or horizontal business model in autonomous driving. So like the WeRides, Nebius, I think it's AV Ride has a subsidiary as well that could play that role. But Mobileye, they're the biggest name in kind of the level 1 autonomous features. So the smart follow, lane assist. I think they have a path to play a similar role for vehicles. Maybe it isn't going to be Tesla. Maybe it's not going to be Waymo. But guess what? Everybody has a strategy. Every single company has a strategy for autonomous driving. They're not all going to be vertically integrated, trying to build their own ride-sharing network, trying to develop their own technology, and also trying to develop vehicles, which is hard. A lot of them are going to lean on somebody else to do that piece, the technology piece. That's where Mobileye has potential. That's why it's in the portfolio. When is the sentiment going to turn? When is revenue going to turn? When are they going to go from selling components for $50 to $100 per vehicle to $2,000 per vehicle? And that's actually going to, really ramp up their revenue, ramp up their margins per vehicle. I don't know. But the idea here is that they could potentially be one of the winners. And if that thesis is correct, that's the 10x opportunity. We're probably still, I would say in the next 12 to 24 months, we'll know if they're going to actually win some of those contracts. If something like Volkswagen is really going to scale up, we'll have some of those answers. So I don't think I bought in a while, but it's definitely one that I'm considering. I should probably look at that one again. Maybe I'll do that for the newsletter over the next few weeks. I do have a long piece that I'll maybe put out as a report just about the whole autonomous driving market. And they definitely play a role in that, but lots of potential winners there. Let me pull up my screen share here and I'll help answer this question with Grab Holding. Have you ever considered Grab Holding? This is a look at Grab Holding. Super apps accessible for mobility, and the relation is it's a little bit like Uber and Lyft. But has Grab Holding ever been considered? This comes from Andy. So some of the same features, mobility, delivery. Some of these overseas companies have this much more super app structure than we have in the US. Here's the reason I haven't bought them. In Cambodia, Indonesia, Malaysia, Myanmar, and the Philippines, Singapore, Thailand, Vietnam, headquarters in Singapore. I've never used Grab. I would be making a lot of assumptions about the world and the way the world works, and the way that other people are using applications by buying shares of Grab. It's okay to just. I feel the same way about Mercado Libre. I've never lived in Latin America. I have friends who have lived in Latin America who will say, "Oh my gosh, Mercado Libre is amazing. This is like the go-to for everything." And that's sort of data that I can pull into my investing thesis. I don't know that I've even ever I don't even know that I know anybody that has used Grab. So again, this is one of those areas where you have to understand what you know and what you don't. This is something that I don't know enough to have a really strong opinion one way or the other. And it's okay to just say, I don't know. I'm gonna stay out of it because I don't need to have a position for or against any of these stocks. So sure, it has been considered. I have looked at it. I just don't know enough to know whether I would be right or wrong about a company like that. If you were starting today as a new subscriber with a lump sum to invest in the portfolio, what would you suggest is the best way to DCA into the asymmetric portfolio? Again, not going to be personalized advice, but I also started the portfolio on autopilot. So that's another way if you want to follow the portfolio passively. The way autopilot works is it literally just makes the trades in your account for you. So I'm the pilot, and then they started with the Pelosi tracker. So it's really cool technology. I think this is something that's going to be really valuable for a lot of people. Sort of takes that asset management piece away from some of the big tech or big bank companies that are just kind of collecting assets, creating ETFs. They have the whole infrastructure, makes it easier to follow people like me. And then I can, I think that's going to be a great way for people to beat the market. But even what I did there was when I started that portfolio, I didn't look exactly the same as the asymmetric portfolio because you had a company like Robinhood that was up 500 or 600%, and I was very comfortable buying Robinhood at 25. I was less comfortable putting 15% of the portfolio in it at $125. So um, I would look at each one of these stocks. Which ones do you like? You look at asymmetric investing as you don't need to copy everything that I do. The reason that I have the portfolio, the reason that I'm doing the research the way that I'm showing you my work. I'm showing you my conviction. As I buy stocks every month, there's a long period of time where I didn't buy shares of Robinhood, but I still owned it. So was it an opportunity to buy? Maybe I didn't see that opportunity as the stock went up in value, but I certainly held it. So, the decisions that you're going to make about buying stocks each month maybe going to be a little bit different than I would make. As I have friends who subscribe and I talk to about stocks that I'm covering and things like that. Sometimes they'll just go, you know what, Travis, I think you're crazy about that one. I'm not going to buy it. It's not for me. Or they'll go, oh, I really like that idea. So I think take that into account with every one of your buys. What I do and provide on asymmetric investing should be a piece of the information that you're taking in, not it's not gospel. So I think that's the way to think about it. If you want a dollar cost average into stocks, I think it's very different thinking about that lump sum versus the building on a monthly basis. But just go slowly. If you're investing a lump sum of money, it doesn't all need to be deployed today. Think about what happens if the market drops 30% over the next 6 months. You're going to want to have some of that cash available. So in the autopilot account, I think I'm at 12 or 13% cash right now because it's sort of similar. It's a lump sum is the way that that's structured. So I'm operating a little bit differently because it is more similar. I'm not doing those buys once a month, because if I did buys once a month and just literally copied the asymmetric portfolio, it would send out like 25 trades or transactions for everybody that subscribed there. So that's sort of like in the weeds on how that one works. But yeah, take it into account when you're looking at what you want to buy, but you don't need to, copy everything that I'm doing with the asymmetric portfolio. It's information, and it's my ability to show my work. Um, but yeah, build your own conviction in those stocks. And if you want to slowly add in, the same things that I'm buying, I think that's going to work out really well long term. Carlos asks, how many stocks would be considered a sweet spot for an asymmetric portfolio? I talked about this a little bit ago. 20 to 30 is kind of where I'm comfortable. But that's not a hard and fast rule at all. So I know people who have 100 stocks in their portfolio. I know people who have six. I think if you're building a diversified portfolio, six is a little aggressive, but maybe I think in that kind of 20 to 30 range is really nice. So that's where I am at with the portfolio. I want to pull up my screen here again for this next question. Please share your views on Luckin Coffee. Luckin Coffee, if I'm getting this correct, uh, they're in China and it's a coffee company. I don't know anything about Luckin Coffee, so I'm not a coffee drinker. Um, my wife is the coffee drinker in the family, so I don't really have strong views. I'm sorry, Het. Um, Here's the other thing to think about, and one of the reasons that I stay out of some of these companies, and this is again something where if you're if you invest long enough, you're going to have some of these battle scars. Companies in China that you can buy shares of in the US, especially over the counter, this is OTC, very, very risky. And the reason is no US investor can actually buy shares of companies in Chinese companies. So you're doing this weird VIE structure, even something like Alibaba. You don't actually own shares of Alibaba as a US investor. I just stay away from that stuff. I it's just a choice that I've made. I've seen too many horror stories. Um, I wrote about these for years, these hot stocks that were going on in China, and then that's where Muddy Waters came from. If you're familiar with the research company that shorts stocks, they really made their name with these companies that would be worth billions of dollars in the US, and they would go do this research report and go, look, this is like a coffee shop or like an apartment where this company is headquartered and their products don't actually exist. I'm not saying that Lucky Coffee doesn't exist, but there are oftentimes risks in some of these companies that, unless you're on the ground seeing them every day, you may not understand. So that's my some of these stocks I go, okay, it's a company based in China, great. It's not for me because I'm not able to directly buy those companies and I'm not able to try their products. So one that I'm just gonna stay away from and look for other opportunities. We talked a little bit about this earlier. What's the risk of Uber and Lyft becoming 0x due to Tesla and or Waymo taking the vast majority of the AV market in 10 years? I think the risk is relatively low. The reason is Tesla is not fully autonomous. This could be an entire hour-long show. I don't think that their strategy is going to work. They have been operating now in Austin for what, 6 months? They have been talking about being fully autonomous for years. I don't think artificial intelligence and cameras alone are going to be the way to do this. Even a company that's a little bit newer to this, like Rivian, who's going to have an AI autonomy day here in the next week or two, they're using radar. The reason that I think cameras alone are not going to work is because you need to have more information. One of the things I don't understand is one, trying to have AI solve everything. Like, what if it can't solve it? What if there's always a hallucination? Like when you're talking about vehicles, the downside is somebody dies. That's not a good risk to be taking with only cameras and artificial intelligence. The other thing is cameras alone, um, you only have visual information coming in. If you look at some of the lawsuits they've actually settled because people have been in horrible accidents, there's one of the risk factors is glare. Glare happens. And if you're building a system, I'm a mechanical engineer by training. If you're building a system that has a catastrophic fault that happens all the time, like glare, what are you doing to solve that? And they have not solved that. You could add lidar, you could add radar. In my opinion, solving autonomy and then taking sensors and costs out because they're too redundant is the way to think about this. So I think Tesla's been talking about this for a very long time. The thesis has long been that they are going to just own this market and dominate it. I just don't think that's going to be the case because so many other companies are moving towards fully autonomous vehicles, pulling that safety driver out. I think we're going to see more and more companies do that next year. So if you have 5 companies even that can do that, there's not going to be 5 new autonomous vehicles. So you're not going to be downloading the Waymo app and the Baidu app and Tesla and blah blah blah. Like you're going to have a central point of demand, and I just don't think this is going to be a winner take all market because the technology is already too diffuse. There's already too many companies that are going to be involved. Maybe I'm wrong about that, but I think the risk is relatively low because in 5 years we're going to have autonomous vehicles everywhere, and they're just going to be a commodity. Again, that's not the way that the market is thinking about it, but I think when you think through the technology, you understand who the players are, who's putting millions and millions of miles of testing on, who's pulling out the safety driver. That's where we're headed. Is there's lots and lots of companies that are going to have fully autonomous vehicles. So hopefully hopefully that's helpful, Michael. Again, with any of these, I could be wrong, but can you describe your process for sourcing new 10x opportunities? What stock filter criteria are you using? What data and sites are you looking at on a daily basis? Really good question. There's I don't have a science for this. I wish there was some sort of filter or screener that I use. I've shown um, I've shown Fiscal AI here, and this is one of the sponsors of asymmetric investing on YouTube. But this is, one of the things that I use. Um, and the simple reason is I can just go through a whole bunch of ideas and look through all of the information that I need. So when I start looking at an idea, let's say I'm, looking at Zillow, and I do have screeners in here. I have a whole bunch of screeners I, that I change over time. So these names don't necessarily mean anything, but looking at gross profit, compounding your growth rate over a long period of time, what kind of companies have succeeded. Uh, so there's lots of different things that I'll kind of test out. But if you're looking at a stock like Zillow, you may want to go in and look at things like the transcript and their earnings presentations and their financials and key performance indicators. So these are the tools that I use, but the ideas typically sort of ruminate for me for a very long period of time. So something like Zillow, I mean, I've been following Zillow for a long time. When they were in their iBuying days, I was actually really excited about that as a potential disruption to the market. When I started buying shares, it was somewhere in this period of time, I think, for the asymmetric portfolio. And you have to, for me, I have to develop a thesis and a view of the world that starts with strategy, right? So the idea for a company like Zillow is I'll be thinking about, okay, who is aggregating demand? Who's pulling demand together? What are the apps that we're choosing to interact with in really big markets? So that's a simple question that doesn't always have an easy answer. So ride sharing, you have Uber and you have Lyft. Food delivery, you have DoorDash. Social media, you have Facebook. And what you want to do is you want to be uh let me try to pull up I've got a graphic for uh the smiling curve. It's a concept that I've written a lot about. But what typically happens with most of these companies or industries is you go through. See if this. See if I can load this up. Okay, smiling curve. Again, strategy concepts play a big role in asymmetric investing because I think if you understand the strategy and you're able to get ahead of that, you're able to find these 10x opportunities over a long period of time, and you're able to see these things play out. So you take something like the smiling curve, and I've got a whole article on this on the site. But in industry, this is excess value or profits. So think of this like margins would be good, or you could look at a metric like revenue per user. In social media, you can do this. You can just graph these companies and go, who has scale? Okay, well, Facebook, Instagram, Meta as a company has the most scale, and then you have Reddit, and then you have Snap, and you have all these other companies. You can just put them on the line, and then move them up and go, what is the revenue per user? And what you find is, well, Meta makes way, way, way more revenue per user than Snap, who would be somewhere down here. So who's profitable? Well, Meta, very profitable. Snap, not so profitable. So what sort of industries are going to play out in the same way that are big opportunities? That we're not talking about, a small opportunity that if you win, you're going to be $1 billion company. What is a opportunity where if you win, you're going to be $1 trillion company? Well, housing, massive, massive business. So again, map these companies. Just take Zillow, Homes.com, which is owned by CoStar. there's a few companies. I have done this one at some point with the housing market. What you find is Zillow has by far the most users, so they would be the highest on the scale curve. And then when you start looking at each of the companies that are competing with them, Redfin is another example. You start to see these holes in their strategies. Um, and let me pull up Zillow here, and you start to see, Homes.com is struggling. CoStar doesn't want to continue investing. So how do we know there are signs that a company like Zillow is winning? And I'm just going through my thought process here because this is the way that my brain works. I'm looking for these big opportunities, and then you're trying to see how an industry is going to play out and the strategies that you can take from. This is what's worked over the last 20 years. A lot of things have changed over the last 20 years. So what works on the internet? Um, you could take everything I'm saying here and apply it to a company like Hims and Hers too. So healthcare, who's going to win that demand piece in healthcare? But then you look at, okay, residential revenue. Cool. They're a big player in residential revenue, but that's not. Now you're going to be playing this, how many basis points are they going to get out of each transaction? It's an advertising business. Is there that much power in the market? All that kind of stuff. What really changes things for Zillow, and this is where once this started to turn, I started to get much more interested, is when you look at things like mortgages and rentals. So now you're looking at if Zillow becomes the app that I'm going to if I want housing at all. I'm looking for an apartment. Maybe I'm an asset owner and I'm looking for renters. I'm looking to sell my house. I'm looking to buy a house. If I'm looking for a mortgage, if Zillow is the first place that you go for all of those things, now you've got a really big opportunity. And so when you see something like, so you start, so you ruminate these ideas, and then you go, oh my gosh, look at this mortgages business. Let's get out of I'll go to trailing 12-month numbers and kind of go after the pandemic because there's a bunch of, let's go since 2022. Mortgages growing 17% on a compound annual basis. That's pretty good. Rentals, look at this. I mean, did you know that Zillow 31% compound annual growth rate in the rentals business? This is the kind of thing where now you have multiple points of demand. You're becoming a demand aggregator for a company like Zillow. This is the way that I come up with ideas is I'm thinking about opportunities and strategies, um, subscription models. I wrote a big article about Costco, and I then that actually led me to I listened to an interview with Vlad Tenev, the CEO and founder of Robinhood. They came out with their gold card. It was actually when they came out with their gold the credit card. They had the gold subscription, but they came out with the credit card had 3% cash back. That means they lose money on every single transaction. Why in the world would they do that? Well, the comparison is Costco. Costco has way lower margins than every single other retailer because they have a subscription business model. They make almost all their profits. This has changed a little bit over the last few years, but historically, they actually made more profit on that membership than they did running the stores. So they're trying to make money on the subscription, not on the actual stuff you buy at Costco. They don't care about selling hot dogs for a profit. That completely changes the economics and the way that you think about a business. And that's where things like disruption come from. So what's the process for finding these opportunities? It's stuff like this. It's trying to find out what worked in the past. Costco, been around for 40, 50 years. Now I'm translating that to Robinhood. What worked for Facebook. Now I'm translating that to Zillow. This is It's a long, sort of convoluted question, but or answer, but there's a lot of pieces that go into it. So hopefully that's helpful in understanding kind of where my head is at with some of these. All right, I want to make sure I get to most of these questions. We're almost at an hour here, so I think that I am at everything that came in from the newsletter. Let me go to comments that we have coming in from YouTube. Webull could take some of Robinhood's market share. Possible, possible. Um, Let's see here. All right, and like I said, if you are not already subscribed, the best place to find all this stuff is the newsletter. Is the link in the show notes on YouTube. But that's where all these questions are coming from. Is people who signed up for that. I'll just go into YouTube here, see if I can find all these questions. PGY, how is PGY this cheap? Not one that I've looked at, so I don't have great comments there. Portillo's, Evan asked about Portillo's and Virgin Galactic. XIFR, I don't know. Portillo's is a stock that I own, not done particularly well. A number of reasons. And that's one that again is just kind of sitting in the portfolio because I don't know yet until we see signs of a turnaround. I'm a little bit uncertain what's going on with Portillo's. Is it a Portillo's specific problem or is it a restaurant problem in general? You can look at the restaurant industry is really confusing to look at today because you can see really great companies doing really poorly. Chipotle is a good example of that. So does that mean that consumers are starting to pull back? Is fast casual becoming more saturated? Maybe that's the case, but then you see like steakhouses doing phenomenally well. So again, I like the story of Portillo's. The valuation could be really compelling at today's price if I'm right that this is a company that does have a lot of opportunity. It's very, very heavily, very, very popular in the Chicagoland area. But you get outside of there, they just haven't built scale in most of these cities. I think the Dallas area, they have a handful of restaurants, but there's just not a lot of places where they have a lot of scale. And you need to have scale to do things like advertising, actually make some, good investments in that. So Virgin Galactic, I've been totally wrong. One of the reasons that it still sits in the portfolio is it's a reminder that 0x is possible. I think the shares are down 90 something percent, 95%. Was never a big position, did not invest much in that at all. I thought it was the idea there was, I have little kids and the things that change the world ultimately usually become really valuable. So like the idea that you can just go to New Mexico and go to space is it sounded insane if you grew up in the 80s like I did. That's actually what they're doing. I was actually down there for one of their for the last flights, and it's phenomenally interesting. They've messed up a whole bunch of things with. I think they should have raised a whole bunch more capital when they had the chance because they were going to eventually have to go to this point where they're going to have to get to commercial operations. They're going to have to become more mature as a company. And they didn't raise enough capital to be able to do that. So now they're at this weird point where, okay, we have enough money to build two spacecraft, but we're then not going to be profitable at that point. They should have had enough money to build four or five, start to generate cash flow, start to build out, their next facility in Italy, places like that. So those are a couple ones that have really struggled in the portfolio because I'm not always going to be right. Just the way that it goes. Next question also about Portillo's. So hopefully that was helpful. Thank you, Krishna. Appreciate that. What are non-Meg 7 companies that you like for the long term, buy and sleep well kind of companies, not risky bets? I like all the companies in the portfolio. Otherwise, I wouldn't invest in them. So there's, 20, 25 companies, 24, I think, companies in the portfolio. Uh, I am not somebody who has a hard time sleeping, taking a lot of risk. So if everyone is going to be different on that spectrum of how much risk you think is appropriate for your portfolio, what are you going to lose sleep at? Don't lose sleep because you're investing in the wrong companies. But if you're able to have a asymmetric portfolio, asymmetric piece of your portfolio, I think that's the principles that I'm putting in place are the best way to beat the market long term. I have not looked at Zeta. Thoughts on Adobe and CRM as they flirt with 52-week lows? Will AI help them or destroy their business models? I don't know. And I could make really, really good arguments on both sides of both of those companies. And that's the reason I haven't done anything. I've invested in either of them. Adobe, the risk, So one of the things I think and write about a lot is disruption. And Christensen's Innovator's Dilemma, I think is a really great book. If you've not read that book, some of the things apply today. Some of them don't necessarily because he was looking at different markets. But the idea that disruption typically comes from the low end is, I think, really something that you need to think about if you're looking at Adobe. So Adobe is the go-to if you're a professional, like if you're making a Hollywood movie, you're making something high production, you're a graphic designer, you went to school for that, you're probably all in on Adobe. I am not. I have a YouTube channel that I need to make a thumbnail for. That's done in Canva. And everybody that's sort of in my position is doing stuff in Canva. Canva is now moving up that curve of being able to make great pieces of content, great graphics. Then you have things like Nano Banana coming in. I think that a company like Adobe is probably going to continue to be that premium company for a very, very long period of time. Does that mean that they live up to their valuation? I don't know. I think, same thing with CRM. If you're starting a new business today, small business, and you sign up for Salesforce, like you look at their pricing, it's insane. So like General Mills is going to stay with them forever. Do you want General Mills as those kind of companies as your biggest customers? That's what's keeping me out of those. So just kind of hopefully that helps with my thought process with some of these. Are you still bullish on Disney? Are they executing as expected? Yeah, here's one that I am very contrarian, I think, against the market. Disney, I think, is one of these companies, and again, this goes back to something like the smiling curve. If you map out the streaming companies on the smiling curve, Disney sticks out as being in second place behind Netflix, and the reason that they're interesting and differentiated is they have two products in particular with Disney Plus, much more family friendly than Netflix is, um, and ESPN, so sports. That's the differentiator for them long term, and I think that's something that could be sustainable as we move to more and more streaming. Now, what will be interesting to see play out long term, especially on the sports side, is are they able to bundle things together? So let's say that you're a basketball fan. It's really, really hard to watch every single basketball game for even your local team unless you have cable. So are they able to sort of figure that out and go, okay, we want to bundle not only ESPN, but we also need some of these other services to come together. So, they have this deal, a semi bundle with Fox. They're starting to kind of play in this realm. They're putting their channels. I think the recent agreement with YouTube TV is now going to make something like Disney or ESPN kind of you move the technology into YouTube TV. That's the idea there. And the streaming business is now, I think it's 3 times the size of the revenue from the linear TV business. So it's already bigger. It's going to be lower margin, but I think the margin in time, the total margin dollars is going to be bigger than cable ever was because the opportunity is just so much bigger. You can have 500 million subscribers, not 100 million subscribers, which is where things kind of capped out in the US. So I still like Disney. I like their position. I think their valuation is really good. And I mean, like, the core is the parks and the experiences. They're making $10 billion a year in operating profit from that business. That's not going anywhere. Nobody's disrupting that. So yes, I like that company. Thoughts on defense companies like Northrop Grumman and Lockheed Martin? Not my area of expertise. So it's just not an area that I have a lot of huge thoughts. Appreciate that. The LV Patel. How much has the energy drink market? I didn't mention. I'm trying to represent stocks that I own here. We got on holding sweatshirt. Also have my Garmin watch on, and gotta have my Celsius when we're doing these shows. How much has the energy drink market changed since their Celsius spotlight? What's your thoughts on their execution? So Celsius is one where part of my thesis was that this drink in particular, and Celsius drinks in general, have a much bigger addressable market than something like Monster or Red Bull. It actually, if you think about just from a gender side, like those drinks are primarily male focused drinks. So the market, you basically double the size of the market if you actually have females drinking your drinks. Um, so that was part of the idea with Celsius. That was part of the reason they bought Alani Nu. So I think those things are working out well. I've not bought shares in a very long time, just because I think the market got a lot more competitive really quickly. And I still think it could be a really good long-term investment, but there just may be a lot of ups and downs, and it's going to be more about getting the stock at the right value than it is this being some sort of rocket like it was a couple of years ago. I don't think the low-hanging fruit has been picked. So I wish I had stronger thoughts about Celsius, but I just don't right now. Hopefully that's helpful. For predicting a good return, Alphabet stock despite prevailing market concerns about significant reduction in ad revenue because of ChatGPT. If you're a subscriber here, if you're a subscriber on Asymmetric Investing in the newsletter, anywhere you're a subscriber, hopefully over the past year, you have heard my thoughts about why Alphabet was the obvious play in artificial intelligence. I have thought that the market sentiment around ChatGPT taking over the world was crazy. And part of that is me. I live in the Midwest, and nobody nobody talks about ChatGPT. Like they don't. This doesn't come up with other parents at soccer games. It's not something that my wife talks about at work. Uh, it's it. So I think we sometimes get into this bubble, whether you're in technology or in finance, where you think that things are happening that are not. Like 800 million users is really impressive for ChatGPT. That's a weekly number. If you use ChatGPT once in a week, you count as a weekly active user. But you be maybe using Google 50 times a day. So they've still got the business, and there's no evidence in their business that they are being disrupted. I think that's really the key here. Let me pull up FinChat again and show some of these numbers, because this is what, like I said, if you've been watching my stuff for a while, this has been, I think, really clear that the disruption thesis was kind of wrong. So again, forget exactly when the spotlight came out, but it was somewhere around here. Um, you feel crazy, you feel dumb when stock is down 10-15%, and then suddenly you hit this moment, you go bam, now the stock's up 78% from at least that point. I think it's doubled in the asymmetric portfolio. You find a couple of those a year, you got really great returns. Okay, so here's what I was looking at is, if ChatGPT was going to disrupt Alphabet, you would see it in a couple of different places. You would see it here, here, and here. Okay, so blue is search revenue. I'll go to trailing 12 month so that we have, and I'm actually going to pull this back to September 2020. Okay, the reason I'm going to do that is ChatGPT came out right about here. Okay, so what happened? What happened in this period of time? ATT from Apple. So Apple there used to be app tracking, where if you made a click on your Apple device, they could, a company like Alphabet, a company like Meta, Shopify benefited hugely from this. They could track you clicking on that ad, and then actually all the way to making a conversion. So if I am a retailer, let's say I'm on holding, and you want to sell Travis this incredibly expensive sweatshirt. I would say it's $100. You say, Alphabet, I will pay you $20 for every conversion. Apple broke that with ATT. And that's what happened in this period of time. You see similar numbers from Meta. If you look at their revenue, it just kind of flatlines. You see it all throughout the advertising business. Eventually, what they went to was not a direct tie, but a probability. So Travis clicked on this ad. Did he probably convert? That's when you get to, because you have to have the infrastructure built, the technology built, and then you have to have advertisers actually believe the data that they're getting from these companies. So What happened after ChatGPT is revenue actually starts to accelerate. So we're growing faster, even though ChatGPT is disrupting search. That doesn't make sense logically. So logically, I thought this was a great buy because they were growing faster. Now the market didn't really seem to realize this till this quarter. Why it didn't realize it in any of the previous 5, 6, 7, 8 quarters, I don't know. And then the other piece, I'll just hide these two, but the devices, the subscriptions that Alphabet has, I think are going to be the real. This is where the real value is going to come out with things like artificial intelligence, and this continues to grow. So, yeah, to go back to the question, like the valuation isn't quite what it was. Go back here. We got a price to earnings multiple is now 31. Forward price to earnings multiple is almost 30. So the market, I mean, analysts aren't expecting a lot of growth there, but I still think it's a phenomenal company. I haven't sold any of my shares. I'm a little less excited about buying at a 31 PE multiple than I was at a 16, 17 PE multiple. But this is again one of those companies. I think if you own Alphabet for the next 10 years, I didn't even show the tremendous growth at GCP, Google Cloud. There's Waymo just hiding there. Just there's potentially $1 trillion business just sitting there, putting no value on it. I just think this is one of those companies that's just going to do really well, and it's kind of the only no-brainer that I think there is in the market, even at this price. Although, like I said, a little less excited about this price. What are the safe haven plays when the market retracts? Utility stocks that pay dividends, gold stocks. I don't invest in gold. I don't understand gold. That's my problem, not the market's problem. It's just something I've never understood. These unproductive assets like gold. I don't understand Bitcoin. So hole in my knowledge base. Here is when you mention utilities and some of the energy stocks, I would say yes, that would be a safe haven in most markets. The question now is a lot of those companies have done extremely well recently because of the AI trade. So the the real need with AI is power. And that's why a lot of these utility companies, GE or is it Vernova, the energy spinoff, has done really well. Comfort Systems is another one that's kind of popped up. They're doing like the infrastructure stuff in data centers. That's a pretty commodity business typically, but they've got incredibly high margins right now because they can charge whatever they want because there's that much demand for things like data centers. That's not going to last forever. So if there is a downturn, I think what you need to think about is, okay, if there's a downturn in the market, then what happens? Like let me pull up another stock here because maybe this is a good example. If we look at Oracle, okay, Oracle, huge, huge, huge jump. I'll just do year to date. This was the jump after they announced that big $300 billion deal with OpenAI, ChatGPT. The problem is they got to build out all this stuff. So you get the excitement phase. Stocks up, I think it was up 40 something percent in a single day. Larry Ellison becomes the richest person in the world for 24 hours. But then over the next few weeks, you go, wait a second, how are they going to pay for this? You go to their financials. Let's look at the balance sheet, cash and equivalents, and then let's look at short-term debt and long-term debt. This is last quarter. They've taken out $20 billion in debt since then. There's over $100 billion, somewhere around $110 billion worth of debt on Oracle's balance sheet. So if the market goes south, it's going to be in large part because things like this happen. Oops. Things like the stock dropping. This may seem like a small thing, but the stock dropping this much is the market telling you, okay, we don't believe the thing that we believed right here. Their debt costs have also gone up. So there's the debt markets. The reason to look at debt markets is because they're going to tell you a story about risk. They're telling you that maybe these things are a little more risky than we thought they were a few months ago. So if the market falls over the next few months or the next year or two, it's going to largely probably be because the investors who need to fund this AI build out are going, wait a second, I don't want to take that much risk. And the downside then could be that these utility companies go, oh, maybe there isn't the growth opportunity that we thought there was. Maybe we're not going to get the rates that we thought we were on some of these assets that we're building. So I don't see a lot of just safe havens in the market today that would just have typically been safe havens, unless you're able to get a great regulated utility for 4 or 5% dividend yield. I don't. Morgan Housel wrote this once that it was something like cash is really the only safe haven because when the market goes south, everything goes down. Like if you look at the actual value of Bitcoin or gold, it goes down in market downturns. It does not go up. It is not actually a negatively correlated asset. It's negatively correlated like previous to, if you look at like gold or Bitcoin during they go up before the recession starts, not after the recession starts. So a little bit counterintuitive. So I don't know if that's a great answer, but that's just kind of my thoughts on. I'm not seeing a lot of safe havens because a lot of the previous safe havens are being kind of overwhelmed by the AI trade right now. Gorski, 3 kids and not a coffee drinker. Yeah, I'm not pounding Celsius at 6 a.m. Start a day with 5 hour energy. So sorry, not publicly traded, but Uber is positioning itself for autonomous driving. They're partnering with NVIDIA. Yep, they're partnering with everybody, not just NVIDIA. Look at their press releases over the last year. They're partnering with any company. They're investing in. They invested in Lucid, who is partnering with Neuro. Neuro, again, think about a modular business model. Lucid's the manufacturer. Neuro is the company that's actually providing the autonomous vehicle technology. So yes, they're partnering with everybody they want more supply in the market. That is Uber's incentive. They want to have 24 autonomous vehicle suppliers. They want 50. Like they want autonomy to be as much of a commodity as possible. So that's really key to my thesis. Uber is a verb, not disappearing. Yep, totally. So totally agree with that sentiment. Answer the question. What do you think about PayPal? I haven't gotten there yet. It seemed like a value for a very long time. Not sure if it's a kind of a value trap. Webull, I just haven't gotten there with that one either. A little bit newer company. It's not one that I use. So I'm not seeing the same kind of business model playing out that we see with Robinhood. That may change in the future. I'm holding Hims, hoping for a rumored new partnership with Novo for Ozempic supply returns. If you own shares of Hims, look at what's the company going to be 10 years from now, 20 years from now. I think looking at even just weight loss and GLP-1s and partnerships with companies like Novo, you're missing the long-term opportunity. I did a big article on the newsletter about my experience. I got the labs done. So as soon as they announced that, I signed up. I think it was like 4 days later. I got my labs done. Really, really interesting experience. And what it does is it opens up the market into all kinds of new areas. So we know the longevity is coming in 2026. Testosterone, perimenopause were launched this year. You have weight loss, you have hair loss. So lots of different areas that they can expand into. And when I originally wrote the spotlight with Hims and Hers, I wrote a lot about like just the pain in the butt of getting basic healthcare where the answer. We need to buy EpiPens for one of my kids. You got to buy those twice a year because you got to have them at home and you got to have them at school. Is it going to be $0? Is it going to be $500? Is it going to take me 10 minutes? Is it going to take me 3 hours when you go to the pharmacy? Like the amount of pain that happens just in that one simple product that we have to buy every single year, that the actual medicine costs like $1, is insane. And so there are very few companies looking at healthcare completely differently. Hims and Hers is one of them. So that's really my thesis with that company specifically. Somebody said in the UK, so can't relate. They're coming to the UK. I mean, I think it's going to be easier for everybody everywhere. this is not just a US problem. This is, the US is maybe a unique situation, but I think using technology to disrupt healthcare is going to be there's going to be at least a couple of massive, massive winners. Again, looking for ideas. This is an area I'm swimming right now. I've got a few things that I'm kind of looking at. Hims and Hers is the one that I've invested the most in, but that's why, because um, I just see that huge, huge, huge potential opportunity where if you're right, if you find the Netflix, if you find the Amazon, it could be 10x, 100x, 1000x returns. Uh, what am I thinking about Robinhood right now? Actually, recently made a transaction with that. So if you go back to the newsletter, I explain that in much more in depth. But recently sold a little bit of my Robinhood because I just think that valuation became a huge piece of my portfolio, and the valuation just wasn't all that compelling, and the risks became different risks than they were 2 years ago when I started building that position. So, do I want to take risks in what happens with the prediction markets or what happens with crypto trading? Maybe not quite the opportunity that I saw then. Still a huge position. So I'm not out on Robinhood, but sort of shifting the way that I think about those risks. Am I still confident in $6.5 billion in revenue for Hims and Hers in 2030? The last time they put out projections like that, they beat it like by a year. Um, it- Again, we'll see how this plays out. I'm not making projections on a quarterly basis or a yearly basis. I don't model anything, because the only thing you know about a model is there's another question about the end of your price target. I don't do price targets. I don't know. I'm looking for opportunities that are going to be much, much bigger than they are today in 5, 10, 20 years. What's that moment that the market is going to realize that Google is not being disrupted by ChatGPT and the stock doubles in 2 months? I have no idea. Hims and Hers could go to 15 next year. It could also go to 300. B- But with that basket of stocks that I own, 24 stocks or so, there's going to be some huge winners in there. And that's exactly what you see is like 4 or 5 stocks have driven my returns over the past 2 years because they have been such big winners. Robinhood, Spotify is another one. Hims and Hers has been up and down, but is another big winner. That's the way you have to think about asymmetric investing as a portfolio. Not necessarily going to be right about every single stock. I don't have a price target. I don't have a revenue guidance. Are they doing the things that I'm expecting them to do over a long period of time? With Hims and Hers, the answer is yes, but there's absolutely going to be volatility along the way. Answered a couple other Hims questions. Uh, Opinion on pharmaceuticals such as mRNA disruptors, such as BioNTech. Generally, yeah, I do not look at pharmaceuticals. Again, I think the what we have seen historically over the last 20 years is where you want to be investing is the company that owns demand in an industry. Okay. So throughout all the ups and downs, Netflix, Amazon were huge winners in their markets because they own that when people open their phones, that's the first thing that they click on. Who's going to be the winner in pharmaceuticals? Well, any one of these pharmaceuticals, the way that things have worked in the past is it was supply driven. So you can go back to like the 80s in retail, and Warren Buffett would say he was buying shelf space, right? Like we own Kraft because you're buying shelf space. The disruption that happened is if you're buying stuff online, shelf space doesn't matter. It's not a limited quantity. So if there's like the whole weight loss segment, if I'm an investor in Hims and Hers, I don't care about any individual partnership. I care that there's a ton of options so that when somebody goes to Hims and Hers and says, "Hey, I'm looking for weight loss solutions," then the doctor or the algorithm or whoever's making the decision can go through, okay, here's 20 options that we have based on you and your costs, costs that you want to be at, how you want to take your medicine, whether you're doing an injection or a pill or a gummy or all these kinds of things. They're able to match you with a solution. It isn't the same as going to a doctor where you're having a one-on-one discussion and then the doctor makes the decision. The messed up thing in healthcare, whether you're in the US, whether you're in anywhere else in the world, is that doctor is making a decision that is probably tied to other incentives. The hospital that they use has a deal with such and such a company. I've had family members who have worked in medical devices. We're a Guidant hospital. We're a Boston Scientific hospital. We're a Medtronic hospital. So depending on where you go, you're going to get a different pacemaker. Is that the right solution? Like, why shouldn't the solution be whatever the correct solution is for you as an individual? Again, you're commoditizing supply because you own demand. That's the story with Hims and Hers. Everything else kind of doesn't matter. Circle went IPO asymmetric potential similar to Coinbase. Guess what? Who makes more money on the USDC stablecoin than Circle? Coinbase does. Coinbase has been in the asymmetric portfolio since very, very early on. So I don't own shares in Circle because I'm getting more exposure to Circle's business through Coinbase than I would through Circle itself. So on my radar, if we get a good valuation, which I mean the stock is traded, I think that could be compelling. Given Lyft's strategy of pursuing non-exclusive autonomous vehicle partners and its investment in low-margin AV fleet maintenance, do you think that Lyft moat? What do you think about Lyft's moat long-term relative to Uber? Uh, so this gets to Lyft. The maintenance piece is I'm blanking on the name. They have a subsidiary that was originally bought so that people could basically you can go to Lyft and say, "Hey, I don't have a car, but I want to drive for Lyft. Can I basically rent a car?" So like a mini Hertz, and then they do the maintenance on the vehicles. They clean them out and things like that. That kind of plugs into the autonomous vehicle. Somebody's got to do that stuff for autonomous vehicles, so that plugs into that market really well. I think that's what they're talking about with that maintenance piece of the business. Uber's doing the same thing. I think in some places they're doing that themselves, so they're starting to build out that infrastructure, and then they're partnering with other companies in other places. So I don't think that that necessarily is the moat. The supply, the demand is going to be the question, and the reason that I own both of those stocks is it's a basket. I think that the demand side of autonomous vehicles is going to be where the most value or a lot of the value is going to be generated. So I want exposure to both of them. Lyft at the time was that I was buying shares was like a quarter of the price of Uber. It was trading for I think 11 times earnings. So again, if I'm right, you get revenue growth, margin expansion, and a multiple expansion. If you can find stocks where you get all three of those things, you're going to destroy the market. So I don't necessarily think that's a moat because Uber and Lyft can both do those things, but it's the reason that I own both of them. So hopefully that's helpful. PayPal and Wise answered that a little bit earlier. I use Wise for something I can't stand Wise. So maybe that's me. It's one of those things. Why I don't know why I'm paying transactions on costs on things that I shouldn't be paying transaction costs for. Um, my PhD is in drug development, and I don't invest in biotech. Very, very, very high risk. I mean, the industry, the VC industry has basically gotten out of a lot of biotech, even though Genentech drove a massive amount of profits in Silicon Valley because it's so hard. It's basically gambling. It's just the reality because you don't know what the solutions are going to be. But a great comment. Um, Invested in Eli Lilly might work. Again, just think about the supply dynamics. Does that point up does that position in the market? Does the supply power increase if Hims and Hers has 10 million subscribers? Maybe it's Hims and Hers, maybe it's somebody else. But if you're, I think the worry would be you become Warner Brothers Discovery, where you're a big supplier, you're a popular supplier, but you don't have any pricing power. So just something to think about. Thoughts on Roblox? Roblox is one I don't get. I just don't. Um, Let me actually pull up. Let me explain this with some of the numbers because I think I differ from a lot of people with Roblox. Okay, so the stock's gone absolutely crazy. So again, I can be wrong. but the revenue growth, where's their where's their operating leverage? Like you go from 500, let's just take this, $2.2 billion in revenue, you double to $4.5 billion in revenue, and you're still losing the same amount of money. I think the business model is broken in a lot of ways with Roblox because you're paying creators that are who are generating the engagement or building the assets that you have, and you don't ever actually make a profit. Um, Not to mention the fact that this is one of the games I will not let my children touch. Um, so maybe that's my own bias there, but that's why I don't own shares of Roblox. We talked a little bit earlier about number of shares for asymmetric investing. There's no magic number right now. I think it's 24, uh, but it has been fewer than that in the past. It will fluctuate depending on the number of opportunities that I see. So there's no magic bullet there. Just like with a lot of different things here, you're just trying to make a solid decision every day, every time I buy stocks once a month, just trying to make the best decision that I can. So there isn't a, you know what, if a certain stock hits this price or hits this PE multiple, then I'm going to buy. It's going to be because those I dealt with this yesterday, right? Yesterday I was the worst trader in the world because just on that single day, it was like I would buy at the highest value and I would sell at the lowest value. I bought a few stocks, I sold a couple of stocks. It was like my day trading decisions were terrible. But over a decade, those are not going to matter. If you look at stocks that have done really well, did you buy Amazon at $90 or $100? It doesn't matter. You're as long as you get the right company and you get in, that's going to be the winning transaction. Um, XIFR was previously Next Era Partners. Yeah, I have not kept up on that one. So that thanks for clarifying that. I was That whole transaction thing was very strange. It just shows you a lot of the contracts. One of the things that happened there that was there was details in contracts that was just really hard to understand where what risks you were actually buying, especially if you looked at the dividend line for Next Era Energy Partners. So um, why don't I let my kids play Roblox? I don't think it's like the games are built to be addictive. I don't Not something that uh I've seen some of the interactions my kids will get in discussions with I don't know who these people are. I don't know what they're saying. I have no control over it. Maybe there's settings that I don't know about. It's choices that we've made. All right. I think that has gotten through most of the questions. Uh, like I said, if you're not already subscribed on the newsletter, that's where a lot of my stuff is going out. Also, if you have thoughts or comments about, I'm trying to think through what would be valuable here. This YouTube native or video native. I tried a subscription earlier in 2025 that was kind of trying to mirror the newsletter onto video. It just didn't really work. Didn't, but maybe this is an hour and a half stream. Hopefully, you guys have gotten a ton of value out of this. Maybe something like that is something that I should be doing more of. But if you have thoughts or comments or questions, there will be comments available on the YouTube stream. Love to hear what you think. I also put a post up on the YouTube channel as well. So something I'm thinking about. I got a couple of people who will come on here, so I'm not just by myself. I actually have another person to talk to. But hopefully that's something that we'll do maybe later this year, starting in 2025 or 2026. So keep an eye out for that. If you're more of a YouTube native person, you want to just talk about stocks, what I'm buying, what I'm doing, and aren't necessarily somebody who wants to read a 3,000 word post about the stock that I'm thinking about this week. I'm understand that not every medium is for every person, so I want to try to meet people where they are. That's what I'm thinking about with YouTube. So more to come, but I'm kind of exploring that space. So let me know if this is something to find value from, because hopefully, people will. I love talking stocks, so happy to jump on and do this if it's something that works out. Thank you everybody for joining.
If you have thoughts or questions, I'll try to do these through the newsletter and comments there at least once a month. But happy to have conversations on YouTube as well. I will be back. Thanks, everybody. Have a good one.